All right, thank you. Well, Marty, thank you for having us here today. Thank you for the folks here live in the Bay Area. And I know we have people joining us from all around the country, if not other countries as well. We're going to talk about private equity. We have Maureen Downey here, and we have Gary. Is that Gary up there? Gary Post. For those of you who participated in this event yesterday, again, either live or via the internet or at our dinner last night, Maureen has an incredible background. She added a lot of value yesterday, and now we'll get to hear from Gary. This morning, what we'll do first is we'll all introduce ourselves, and then we have a pile of questions to get to that we've been working on over the last week or so prepping for this. And then Marty, you'll keep us posted if there's any online questions. I know you'll usually have questions as well.
Yeah, and you have Ben Brandes as well.
Oh, I'm sorry. I didn't know that. Okay, Ben, great. Well, I'll write that down. Great. All right, so I'm as the moderator, I'll go first, I guess. Andrew Hurvitz. I grew up in the Boston area, a lot of investment talent there. So it's a big industry there. First half of my career, I was on the buy side, being an equity research analyst, focusing on what I called all the fun stuff, consumer stocks, casinos, restaurants, hotels, cruise ships. And back before this little company called Amazon was around, the retailers made a lot of money, Macy's, JCPenney. But obviously times are different. And the second half of my career, I had to make a pivot to institutional sales, and I've mainly worked with alternative products. So that's why Marty selected me to moderate this panel today. I've worked with a long, short, publicly traded mutual fund, and now the last two assignments I've had, including my current one, pure private equity or private offerings for accredited investors only. I hold the CFA designation and some FINRA licenses 7, 22, and 63. And with that, I will turn it over to Maureen right next to me here.
Thank you. I know, but so my background is that I spent the first part of my career working on the sell side in investment banking and on the trading floor, doing structured finance, credit derivatives, and then later, M&A in Europe and in the US. And then I moved over to the buy side, where I've been doing private equity, some allocation work, much secondary work, both directs and funds, as well as co-investments and direct investment. And I've done that globally across both venture, growth, and buyout, as well as credit.
Thank you, Maureen. I guess we'll go to Gary and then Ben.
Hey, thank you, everyone. I wear two hats currently. First, I'm on the investment committee of a multifamily office based in Utah called Andina, and that's Andina, not a family name. It's for the Andes. And as an MFO, we look at all sorts of asset classes and focus a lot on alternatives. Secondly, I'm the managing partner of a growth capital fund called the K Funds. We're on our third fund. And the activities of the K Fund were largely initially sponsored by Andina family offices. And what we've been investing in is multi-stage, from strong Series A up through pre-IPO. Like SpaceX, we were in 8 years ago, and we consider that a growth capital investment. We're looking for companies that, one way or the other, use information to do things better. And that cuts across a variety of industries and a variety of opportunities. And most of our backing is from family offices. And that's my background, starting with McKinsey, where I worked for family offices on their acquisition programs.
Ben, thank you, Gary.
Thanks. I'll first say that the private equity is a small world, since I think that we probably have, this panel has connectivity to each other. So I was a former investment banker. I did high yield bonds for casinos.
Nice.
Andy. I live in Boston. Gary, I think I've looked at your portfolio for K funds, and I probably am a customer of half of these companies. They're great companies. And my background is investment banking, private equity. I currently invest in age tech. So age techs is products and services geared towards the aging population. My thesis is everybody's aging. Try to dispute that. So this could include durable medical equipment. It could include things that allow people to age in place better and more gracefully and be able to communicate with residents, other residents, family members, and doctors better. And I will tell you that I've invested in healthcare, franchising, telecom, communications, cable, all kinds of things. I've never seen an industry where such an imbalance between demand and supply than products and services geared towards the aging population.
Well, that's, I spend a lot of time in Florida. My family's there, and I hear what you're saying. We're all living longer, which is great, but we need to have some new products and services geared towards an older crowd. So with that, we're going to go to our first question, and not in any particular order, but as a salesperson, I get a lot of questions at my fund and our offerings. What's the distribution? I know out here in the Bay Area, there's a lot of funds and companies. They're not really offering income. It's all at the end when they go public or they sell out to Oracle or Microsoft or name any company we can see in 20 miles, from this building here. But as far as the folks looking for distributions, that's one of the reasons they go to private equity. With interest rates officially being slashed yesterday, I'll just start with Maureen since she's next to us. How do you think distributions will play out in this lowering or lower interest rate environment?
I'm not sure it's going to move the needle too much in the next, I would say, 3 to 6 months. I think interest rates will probably need to come down a little bit more to make the financing environment, maybe more compelling for, buying with financing. And I always think of it more from an M&A perspective, because most of the time, rather than an IPO, most exits actually occur on the M&A front. However, there still are a lot of private equity funds that raise capital before things became really difficult to raise capital. And those funds are coming up on their 5-year investment horizons. So, having lived through the global financial crisis and, when things were in disarray for about, I would say good 12, 24 months, there was a lot of discussion at that time for pushing those funds to give some of the money back because they weren't actually being able to deploy it. I've never seen a private equity fund give back money. So I think you will have, I would say, more impetus there to actually deploy that capital. So I do think that there will potentially be more deals that will happen. So I anticipate distributions will increase. The other thing I would also say, though, is if you look back in the last, I would say, 5 or so years, there's about 2,000 funds. This is more on the venture side that raise capital 30 million and below. Many of those funds are at the point where they will need to raise a new fund now, and they're not going to be able to raise a new fund. Right. So I think what you're going to also see here is many pro ratas being sold off, to try to, and that won't necessarily maybe generate capital, but you'll probably see some of these smaller funds start to sell their positions in order to show some DPI. So I do think there will be more of a push to get more distributions. The question is, does it happen in the next 6 months, or does it need to take another 12 or so months to happen?
A year or more. All right, let's get some feedback on that. We'll mix it up and go to Ben next, and then Gary.
Well, I want to add on, I guess, to a little bit what Maureen said, is that the beauty about private equity is that there's some creative ways to get distributions. Some people would argue there's a huge game of musical chairs between private equity firms selling to each other.
Right. Totally.
And and it's hard to determine when that last chair will be pulled out. Since dry powder has reached a level of almost $3 trillion and is increasing every year, there's such a pressure and so much money out there. And remember, dry powder does not include leverage. So if you got 3 trillion of dry powder, you've got like 6+ trillion to spend. That's a lot of money for private deals. So I think that private equity will always think of creative ways for distributions, whether selling to other private equity firms if necessary. Obviously, private credit has increased dramatically, so you can take maybe some dividends off the table. You can structure mandatory preferreds. So there are some ways that dry powder and the level of private equity fundraising amounts will continue to increase regardless of interest rates and other factors in the economy.
Gary?
Yeah, I'd like to point to the enormous amount of private companies that need to get liquid.
Yeah.
These are family-backed companies, family-managed companies where they're not going to go passed down to the next generation. There's no interest, no capability. And these have a ticking time clock in the sense that the owners and families will need to do something. I think that's a tremendous possibility out there. I think the private equities, dry powder will fit right into that. And the question is, will they get the highest prices they ever possibly could have gotten in the last 10 years? Well, maybe not, but the families are still going to do well and they are sell. But I'm talking about more the private equity, traditional buyout model. The more later stage growth capital, it's a question of how fast can they grow to be viable to be sold. And I think that those are coming up. We've seen a lot more liquidations in the last 6 months than we've seen probably in the last couple of years. So I'm cautiously bullish on distributions, and certainly distributions play into capital raising as well.
Great, thank you. So next question, perfect segue. As a salesperson, I'd like to know what you think the environment is for capital raising. The best environment I've seen in the 15 or so years I've been in the sell side of the business was 2022, when the market or the S&P at one point was down close to 30%. I know it came back and only lost about half of that round numbers, but my phone was ringing off the hook in 2022. So unless that happens again, what would be the tipping point for maybe capital raising going better, which, you know, makes everyone's life easier? And we'll mix it up and start with Ben this time.
It depends on the manager. The top 25 private equity firms control 25% of the entire private equity market. So they never need to quote unquote fundraise. You know, people are throwing them money. If you're an emerging manager, it's extraordinarily difficult. But I'll tell you one interesting development. I was part of large funds. At one point, I raised an SBIC fund, and now I am an independent sponsor. Okay, so I raise capital on a deal-by-deal basis. I do not have a dedicated fund. I would never want a dedicated fund. I don't need a dedicated fund. So Andy, that's not captured into any of these statistics. If I go to an independent sponsor conference, there's going to be literally hundreds upon hundreds, if not thousands of independent sponsors and capital providers that are not taken in consideration in these statistics that are out there doing deals. So the deal making environment is as great as it ever was, even if maybe dedicated fund capital raising is a little bit down, but I don't think it's going to be down for the top 25 funds. They're always going to be, they don't even need placement agents. So it's still a robust market.
Okay, Gary.
The outlook for capital raising, can't get worse. I think there's a certain point in time that capital raising is tied to, I think, liquidity. And as people see more distributions, they're going to be more likely to reinvest. I think that's part of the clog up in the difficulty in raising capitals because there haven't been enough distribution. I think that those investments are being made, but it still could be a while before there's any robust capital raising environment for funds. However, individual like Ben is as an independent sponsor, I think those are doing well and will continue to do well when people have a bite at a specific opportunity. I think that is definitely that should be well.
All right, we are going to go to Maureen, but
I just have a
boss
question.
here has
I just have a
so
question
we have to
for
let him
the panel, which is, you know, you're saying there's no distributions, but maybe I would say it's like, you know, mark to market. And maybe one of the issues is that Ben, when you see stuff, things are pretty much mark to market of the deals that you're looking at, right? Whereas people have had prior investments, the market has changed dramatically. I think that might be an obstacle to getting new dollars in the door for funds. So are you guys seeing any of that clearing at this point, or?
I think it depends on what sector you're looking
Okay,
at. Yeah,
so-
yeah. So I would say in venture, if you talk to someone in venture, they're like, oh, there's already been a reset. The valuations have already come down. And I would say probably not if you have like a real kind of conversation, because I definitely think that there's more valuations to come down. And so when I'm looking at companies and I'm looking at valuations, I definitely look at, where was the last round done? When was the last round done? Who was in the last round? Is it a bunch of insiders? Oh, is it a convertible note? There's all kinds of, I would say, interesting structural ways you can get around the valuation question. And no one wants to do a down round company, and funds when they're out there trying to raise money, they don't actually want to mark their portfolios down. So there's that inherent tension right there.
Right.
I think when you're looking at buyout portfolios, the other thing I look at is like, okay, when was the last time you put that financing in place? Are you going to have a big refinancing cliff? Oh, so you're going to have to refinance that 3.5 facility at like 8.5 now. So, I think there's
Good luck.
there's a number of things that come into play when you are a manager out there and say you've already done 2 or 3 funds. You have to talk about like what you've done with that portfolio, how that portfolio is currently doing. What did you learn? How you're going to reposition it? So I think there's a little bit. There's also too, how do you speak to how you've managed through this transition with the macroeconomic effects? The second thing is I don't think you could ignore the fact that we haven't had a lot of distributions, and in fact, I've advised a number of funds, and in speaking to some of the LP capital providers, they said, well, let's talk in Q1. Because they're expecting like Q4 to produce some distributions. And they're saying, maybe I'll have some more distributions, maybe I can make an allocation. So I think there is a linkage between when distributions come and your ability to kind of basically allocate. And some of the, GPs, especially, not GPs, but LPs who have to use part of their distributions for their operating budget, say an endowment, they are thinking about, do I feed my existing stable, or do I carve out some more to give it to a new manager? So it is to Ben's point, a very difficult to raise capital if you're a new manager. The interesting and the corollary to that though is that if I go back to like the time of 2009 to 2010, those were some of the best vintages. If you put money into those funds, those are great, right? Because they had to work so hard to get the capital, and there wasn't a lot of capital going on. So the managers who do raise, especially ones that are newer managers, will probably do quite well in this environment. But I don't think we're out of the woods yet in terms of valuations and actually a really resetting of the market. I think we're still in that process.
Ben?
Yeah, in terms of that, well, what Gary said is music to my ears, because probably the changeover in ownership of private companies, whether it's generational transfers or other things, that's how I make my living. So, I work with families attempting to, maybe they don't have a family member that wants to take over the business. They have an executive or somebody else. I fund those folks to buy out the family's interest and sponsor those. So in those situations, in terms of valuation, there is no mark to market. There's no market. I'm usually a first institutional investor. And these are legacy situations that are based on emotion, not as much about price. So the valuations remain the same, but there is a little bit more creativity in the structure. So I can offer a family the same valuation as another private equity firm, but I might have a little bit more creative processes. I could have seller notes. I could have earnouts. I could have other things that are being used more in the market because valuations are not coming down, but I still need to get deals done. And those are becoming more accepted in the market, especially if I've built a relationship as a first-time institutional investor with those families.
Gary, anything to add?
No, I actually kind of echo Ben's on the growth capital side. We've had very good appetite for individual SPVs, interesting companies. People respond to those. They respond quickly. Reacting to an entire fund is a bigger bite and a little bit more problematic for some people that haven't received the level of distribution as they may be expecting.
wonder though, if that's really a question, 'cause I've heard the notion of the SPVs now and, you know, obviously the fund, the sponsor. Do you think that's more of a pushback in terms of just not wanting to pay fees and carry and hoping to be opportunistic in a market where capital is pretty scarce?
Well, they still, and SPVs still pay fees and carries generally. They might be less than a fund. Something people can get their arms around and see the value, kind of establish the value in their minds, and it's easier for them to make that one company commitment. And yes, it's at a lower fee and carry, but I don't think that that's really the motivation behind doing single deals versus a fund. I think it's a different set of dynamics.
So I'll just add to that, somebody here, I think it was Ben, mentioned newer and or smaller sponsors. I think there's a bigger trend ongoing of folks, meaning institutional investors, you know, accredited investors, family offices, whatever you want to call these folks, willing to allocate a small portion to what I call emerging managers. As an example, I'm going to an emerging manager conference next week, way on the other side of the country. And so there are folks who say, you know what, Blackstone, BlackRock, they do a great job, but these small, nimble managers, the Bens of the world, can do a pretty good job and maybe pound for pound, maybe charge me a little less, maybe get my money back quicker because they're working on a smaller project. And that's something that's just too small for Blackstone or BlackRock to get involved with. So I'll just add that. But we also mentioned fees. That was one of my questions I had. So who'd like to take a stab at fees first? Because that's another way that you can attract business is by undercutting, you know, a firm that charges more. Some firms are willing to do that and some firms aren't.
I'll take a shot at that. I mean, the only thing with emerging manager is that it's really expensive to get a fund off the ground.
Sure.
So if you are raising 50 million, 100 million, and say you want to charge a 2 and 20, when you actually do the math, and when you think about, like, you know, if you do need an office, the infrastructure, paying a placement agent, paying the salary, it's a lot of money, you know? So an interesting question I think would be, I've seen a number of models out here because a lot of times first-time funds do quite well is doing GP stakes along with, you know, making an investment in the fund. So that's another way that people have thought about from an LP perspective to make an attractive return. But I think that you also, I think there's a number of things you need to consider. Like if you're looking at an emerging manager and they're charging that typical 2 and 20, you know, there has to be a certain amount of size in order for them to raise, in order for that fund to become viable. Otherwise, it's very hard for that franchise to get off the ground. And so that's something that people need to think about. When the bigger managers, when they actually get to their like 6th, 7th, 8th fund, you know, one could argue that sometimes they're not necessarily always as motivated for the carry because they're already getting so many fees. And I was talking to a business school classmate of mine who's, I think they're raising their 5th or their 6th fund, but he was like, finally, we're raising like 1.5 billion. He's like, I have excess management fee. He's like, I've got excess management fee for this. And I was like, wow. And I mean, this has been like after 24 years, right? So, you know, and so I think the thing is that yes, fees are an issue, but one of the things I don't think LPs maybe realize as much, some do, of course, is that when you break it down, what it costs to run a PE firm and pay for an associate or analyst, it's quite a bit.
I know, I hear what you're saying, but as somebody who's worked with smaller managers, both on the buy side and sell side, you kind of alluded to it. I'm going to translate your words if you don't mind. When somebody out here is running a PE fund and they're on their 6th or 7th fund and they have excess fees lying around, and what are they doing at 2 o'clock in the afternoon when they should be working? They're online picking up beach houses in Malibu. They're not as hungry anymore. You know what I mean?
True. Which is why a lot of times people say small mid-market, small buyout sometimes outperforms large buyout, but those large buyout guys were at once the smaller mid-sized buyout guys because you lose your hunger, your alignment. So
Isn't fee compression the nature of financial services though?
It is, but it's kind of eluded, I would say, private equity. I mean, there are obviously concessions, like if you come in with 1.5 billion or 2 billion as an LP into one of these big mega buyout or buyout managers, yes, you know, there are these
Pure foundational investors.
Yeah, exactly.
So, I'm sorry.
Okay.
At my last firm, without naming names, for the fund we worked on or the offering, instead of coming, if you were one of the seed investors, it doesn't matter if you were big or small, more so first to get this thing off the ground and start covering the, you know, expenses of lawyers and analysts and lights and tables. Instead of the 80-20 split, we offered 90-10, and that got people's attention. So we still got our 2%, if you will, but 5 years from now or 7 years from now, when the fund closes, 90-10 is a lot better than 80-20 last time I checked, but we got money in the door right away. So there's another way to do it. Okay, so let's move on. How about the regulatory environment? I'm a big political person. We're not going to get too political, but we've all, you know, all these speakers over the last 24 hours or so have talked about this state and that state and the popular vote in House and Senate, but nobody's mentioned one thing specifically that I think is important. Kristen Sinema, am I pronouncing her name correctly, from Arizona? She's retiring. She's bailed out the private equity industry on a few bills in the last couple of years, and I haven't heard that mentioned. I think that's an important point. So does anyone, I live in the eastern half of the
Bailed
country.
out by. what do
Well,
you mean
she
bailed out?
saved the, what was it,
The
carried interest bill one
Carried
time.
interest, okay.
So, and she's leaving. So I think that's an underrated point we haven't discussed yet.
Who voted against, who was voting to get rid of carried, was that a Democrat thing or?
Probably, yeah.
Probably. Yeah. I don't know that myself.
But I think that's an underrated point we haven't discussed yet, that one of the champions of private equity, for whatever her reason was, I don't live in Arizona, I don't know. She's leaving, and I think that might come back to bite private equity sometime in the next 2 years, depending on who
That's
wins.
interesting. I didn't realize that.
Anyone have any comments on that, especially you folks who live out west, you're probably more familiar with her than me?
Well, we haven't heard of carried interest being a
Yeah.
target in recent conversation. I'm not saying that it can't be, but I don't think that that is a target. Some of the people that it hurts are people that are big fund donors. So I haven't heard it yet. Haven't heard that.
Well,
This-
Right, you haven't heard it because she's there blocking it.
Yeah, I have heard, or I did hear kind of a rumor that they may, they were thinking of taxing unrealized gains, but I think this is more of a broader swath, you know, in people's portfolios, and I've heard the arguments pro and con. I don't know if necessarily know it will come anytime soon. I know we already do get tax on phantom carry, right? You have to, that's why you get the tax distributions. But I would think my thought is there's such a big private equity industry and it's not getting smaller, that you'd have a lot of lobbyists and a lot of pushback if it got really serious. But I think it probably depends on, to some extent, which party controls which part of the executive or
Exactly.
legislative, you know. I think if you get one party that will dominate, and if there is, you know, the continuing budget pressures, this will probably come back on the table.
That's my point, exactly. Thank you, Maureen. All right, I'd like to move
It's been
on.
out there for a while.
Right, and it keeps
It
getting
really
shot
has
down
been.
because
It's
she
been brought
bailed them
along.
out, to use my line.
It's Bernie Sanders and Elizabeth Warren's big bugaboo.
Right, all right.
Ben knows about this, he's in Boston.
Well, yeah, I mean, I know we want to move on. I think this is an interesting but much broader discussion. I mean, the fact that there's bills out there that have some level of taxation on unrealized gains is unbelievable. So
I know, but we
you
do
know,
that on property tax, and somehow that everyone does it, everyone,
That
because
is
we're used to
that
it.
is the argument.
Right, I'm not
Yeah, yeah.
in favor of it, I'm just saying
Right.
that everyone's like,
I've read
oh, we
both
can't
sides.
do that.
Yeah, but
But
then
we
you
already
can
do it. Right,
Yeah,
it's
so
just
that's-
that we're used to it.
Yeah.
Although that's typically on depressed property valuation. It's not market value a lot of the time.
Well, right, they're usually, the assessors are behind the times, they're not.
But everybody that I know that lives in like Chicago, like they tell me they hire an attorney every year to kind of debate.
Right,
the-
that's a
what they
big
do.
thing.
You can fight
Cook County.
valuation.
Exactly, yeah, so.
All right, so we're gonna get to my topic, so if you don't mind. I'm a big college sports person, and the money throwing around now with name, image, and likeness, for you folks who aren't familiar with that, these athletes, some of them are literally making more than NFL quarterbacks. It's unbelievable. And now private equity has been allowed to get into the NFL. I guess it was already allowed to be in the other 3 pro sports, but now it potentially could, you know, rival the television money these folks are getting, these teams are getting, these schools are getting. So is there any talk out here, the big private equity hotbed, I'd love to know it, of getting into the college sports game instead of the 950th tech company in your portfolio? No?
Well, I am not the best person to ask for this, so I might defer. I mean, I've heard about private equity getting into, but I don't think I have as much familiarity to make.
Yeah, I'm just throwing it out there. If
Yeah.
if
Maybe
you
Ben
haven't
and-
heard of it,
maybe
it's
Ben
probably
and
not
Gary.
big here.
Yeah.
What, Marty?
Maybe Ben or
Yeah,
Gary.
sure. Ben and or Gary.
All I can say is that there was a great article in the Journal about David Rubenstein's ownership of the Baltimore Orioles today.
Right.
But one thing to note, and in Boston, there is a lot of private equity individual people who are from private equity who own sports teams.
On the
right?
Celtics, sure.
Correct.
Yeah, didn't
Okay.
Mark Lassery start a fund recently?
And he owned the Bucks and they won the championship.
Right,
and
he
then
sold it, and then he started a fund solely on sports.
Oh, I didn't know
It's
that.
a
Right.
huge fund.
Right.
He started.
But that's my point. This could be one of the newer funds. Again, we don't, with all due respect to you Bay Area people, we don't need the 950th tech fund.
So
Yeah.
it's such a tidal wave. It's unbelievable. There's already platforms out there that are doing high school athlete funds.
Right.
So they're giving them loans until they go to college, and then when they're eligible, they'll pay them off.
Right. So I'm just
college,
bringing it to
right.
everyone's attention that it used to not really be involved in sports too much, other than owning the teams, as Ben noted, but now it is. So I just wanted to bring that to
I think
everyone's
Bronny
attention.
James was making $4 million a year as a bench warmer at UCLA.
Well, what I heard is the quarterback at Ole Miss has a private jet contract. I mean, that's part of his NIL. He's a college student. He has a private jet. Wow.
So it's a lot of money. I mean, when you think about it though, and you go to like, say, places like Latin America or Europe, and you look at like the footballers, we call them footballers for their soccer. I mean, it's just the money that swirls around that market. And then if you look at like our market here, basketball, baseball, football, American football, I could see it. I would say that it may cause, it will be interesting to see how it plays out in terms of how it really impacts, like, say, recruiting and admissions to these colleges. I mean, we just went through the Varsity Blues scandal, which was pretty impactful out here. There were a number of people implicated. So, yeah.
Including a lot of lawyers, I know.
Yeah.
Right. Yeah. USC, I heard, was involved without naming names.
Yeah, Stan, there are quite a few. So I'm wondering, that, yes, this is becoming a bigger market, I have heard, but I'm wondering also too, will that start to produce like regulations potentially?
So
Yeah.
let me, my only comment is that, StubHub, which was started by a fellow Wharton guy,
Mhm.
was, and he went to Stanford as well. It didn't drive down ticket prices. They've only gone up when you associate all the fees and everything else. And so there are entire industries of people who are trading. You brought up Latin American soccer players, Latin American soccer player contracts to Europe. It's an industry, right?
It is good.
So people
Barcelona,
will
Madrid.
trade that. So European soccer clubs will go and look at Latin American players and just buy their contracts out. They'll pay them, a couple $100,000 and then pay them millions, right? To buy out. So it's a huge industry. It's only getting bigger. And as the whole name, image, and likeness is permeating into the high school scene. And in one respect, it's actually a remarkable policy change, because when you think about Title IX, the whole point of Title IX was to make things fair, and it's totally going around Title IX, right? You could be like a lacrosse player, but if you're famous at some school that only has traveling lacrosse, they don't even have a team anymore. It's become a club sport. But if you're good enough and popular, you look good and you can carry a stick, maybe you can make $1 million.
Sure. All right, well, we have time for one more question and then closing statements. So Ben, I'll address this to you first, being in Boston. Big controversy in Massachusetts now, I'm reading, and Ben's there, with Steward Healthcare going bankrupt, and now they want to re-regulate, the private equity folks being involved in healthcare because they're threatening to close down hospitals. So it's one thing if your investors lose money, that's not good, but when you're shutting down hospitals, that affects the regular person, not just the people out here in Palo Alto pushing paper around to make more money. So Ben, any comments on healthcare and private equity?
Well, yeah, Steward Healthcare ended up being a bad investment. There are bad investments out there. So that's going to happen in healthcare, in any particular industry. The problem is with private equity ownership, especially in a state like Massachusetts, is there's going to be more notoriety versus situation, and that has certainly a direct impact on patients of the hospital, employees of the hospital, similar to other industries. Do I think we'll have a long-term effect on the ability for private equity to own certain companies or be in certain industries? No. If they can be in college sports teams, if they can be in professional services, if they can invest in marijuana dispensaries and cigarette places and all kinds of things, then I don't think that a generic healthcare or for-profit urgent centers, wellness, veterinary is going to have any impact, but it is a bad look.
Right, it's a bad look. Gary?
I see investment in healthcare increasing rapidly across all sectors. And I think it's going to be a positive for the management of many of these assets. But from an overall growth capital, private equity, the healthcare sector will attract a lot of money and I think make a lot of good in this industry. So it's something that we're looking at, but we've never wanted to manage doctors or hospitals or facilities. And that's a game for people who are specialized in it and I think can bring good value to it. We would support them.
All right, Maureen, you get the last word on this and then we'll go to closing comments.
I would say healthcare definitely is an area that needs to be, I would say, disintermediated, disrupted, changed with more capital. I mean, it's certainly the highest growing part of our GDP. It just keeps taking up more and more capital. Most of my family are in medical. I'm the only one who's not. So I hear about it all the time. However, I do, and I can recall many times when private equity has made a mistake with an investment and it's ended up on the front page. I'm thinking of like, you know, assisted care homes in, you know, the UK. This came up about 10 plus years ago. No pension fund, you know, no endowment, but no pension fund wants an investment that's in their portfolio to be on the front page of any paper. That is a situation where, you know, I used to work for a big fund of funds. You get a lot of calls because their constituents, you know, see this on the paper and they're like, I see that, you know, pension fund of X is in. So I think it may be somewhat different if you come from a family office perspective. You know, obviously nobody wants that kind of negative attention. But if you are a public fiduciary in a public plan and you see a hospital being shut down or bad actions happening at an assisted care living facility, you know, it's just very bad for you when you go to. So I think that it will depend a lot on who your underlying investors are, you know, and how sensitive they are.
Great. I guess we have a question from the audience, please.
Okay, so one thing, as far as history of the capital gains and the unrealized capital gains, during the Depression, people suffered massive capital losses. This is the Great Depression, you know, of 1930s. And so they limited the capital loss cutoff to $1,000 a year. Somewhere 20 years ago or 30 years ago, they raised it to $3,000 a year. So just think of what's happening. And, you know, Harris has proposed this tax on unrealized gains for people who have over $100 million. So there's a bull market today. They get this tremendous windfall of profits. They're talking about what, 40% tax on all these unrealized gains. You know, it's a yippee-ki-yay for all the Democrats. They got all this money. Now we have inevitably a cyclical downturn.
And then what happens?
And then what happens?
Do they get a refund the next year?
Well, that's the point. They haven't addressed that because there could be massive refunds in that. Plus, the government's already going to reduce overall from everybody who's got realized gains because that goes down. But the other thing is how do you value some of these more esoteric things? You know, like your personal homes, a luxury yacht. Art. You know, we have this guy, Alan Schneider, talks on art. You know, that's a pretty difficult area to value, especially when there's no sales and stuff. So there's lots of things that is really, really, really fraught with danger. And it hasn't, you know, maybe it's just a talking point. But
is there a question in there, Gary?
No, what I'm saying is it's a tough thing. Yeah, there's no question. But it is going to be a problem because if you do it, how do you make up for the losses?
Let's go to the next question.
This is more of a question for Gary Post at K-Funds. You know, similar to Maureen, my family came from the research background, right? And so I just remember how hard it is to get research grants for, you know, meaningful research, right? And you got big pharma that has the deep pockets in this space. And so, you know, I kind of interested in your point of view. I was very impressed with your partner last week in New York from K Funds. I thought she was very intelligent, one of the more transparent, venture capitalists that I've talked to. Most of them are very smoke and mirrors, is my experience, just living in the Bay Area for 15 years. But I would love your perspective on, is front end research going to always just stay with the NIH and NSF, or is there any interest from groups like you to fund that?
There's not an interest by us. I mean, what we've we started 10 years ago. We started looking at where the mega trends were going. And one of the things we did, and I hope this is not getting out anywhere, is we decided to avoid regulation as much as possible. So the kinds of things that are grants in therapies and such and devices, we steer clear of. The regulation and grants needed for information services relating to healthcare come earlier, and probably earlier than when we're involved. So it's not something we look at or depend upon. So I don't have an educated view of will those grants continue. The question that raises is not is a $100 million, is it an entity that would be subject to this capital gains tax on unrealized gains? If so, there would be pretty much chaos in the markets if that ever went into play. I don't think it's going to.
I have a quick question for Gary, and it's a yay or nay. Is there an opportunity in all of these colleges that are folding and being acquired and merged? Like in Philadelphia, there's like a college is being merged every year in the Pennsylvania area. Any thoughts on that? Is there private equity opportunity or no?
Yeah, yes, there is. And there's also a question of what happens to that real estate.
That was my other question, right? Yeah.
Well, you can look, there's one here locally, Mills College, which used to be a women's college, was acquired by Northeastern.
Yeah.
It's now a campus for Northeastern.
They've been very impressive with their real estate program, I have to say, Northeastern, not just in the US, but overseas. Well, my son is a senior and he's applying for colleges. The amount of waste from these colleges is immense. So, like when you see a college like this actually expanding with real estate, then they're putting the money somewhere,
Yeah, I'll just make a comment about college, which is that the college product has changed remarkably since most of us went to college. I think when I went to college, 80% of the professors were tenured. And I think now probably it's around 20% or less. So the probability you're being taught by an adjunct professor is pretty high these days.
Yeah, it's a real problem in this state in particular,
Yes.
right? The CSUs have a much better education than UCs, for example,
And
right?
the pay hasn't really increased to keep up with inflation. So, but anyway, great job, guys. Thanks so much.